Welcome to the Lavasco Briefing Podcast. We've got something important to cover. This is for our clients and prospective clients out there. But we want to talk a little bit about the capital markets going into Q2 2026, right? You guys have
Yes.
come prepared with your typical slides that you go through. So I think the first slide talks a little bit about where the S&P 500 is. Who wants to kick us off?
I can kick us off. I think this is a interesting time to talk about the S&P 500. I think probably the biggest question from a lot of people is, what's going on in the market right now? Where do we anticipate the market heading for the remainder of the year? And I think one of the more challenging aspects right now is that it's really hard to put your finger on one particular item that's causing some of the volatility. Probably the most obvious factor that's playing a big part right now is some of the geopolitical uncertainty. Everyone knows what's happening right now with Iran, how that's affecting things like oil. It's creating some concern on how that may impact the overall inflation in our country. So if you recall, back in 2022, when the market became very volatile, interest rates were rising. A big factor in that was the inflation we were facing. So there's some fear that this geopolitical uncertainty is going to play a big factor into potentially higher inflation, oil prices in particular staying higher for longer. But I think one of the other interesting factors in all of this is what a lot of people were already expecting for 2026. And we talked about this a lot last year when we were doing our market and economic update, and that was around interest rate expectations and what the Federal Reserve was going to do with interest rates. And, we already saw interest rates starting to fall in 2025. The Federal Reserve were starting to take some action. And there was an expectation that rates were going to continue to fall into 2026. And, given what's happened lately with, the war with Iran, what's happening right now with some of the inflation concerns, and pair that with what's happening right now with some of the jobs data that we're going to get into later on. The Federal Reserve is a lot more cautious on what actions they're going to take right now with interest rates. And so people are kind of rethinking if rates are going to actually fall or if they're going to stay higher for longer. And generally, when rates are higher, we tend to see the economy slow less. And some people may say, okay, well, why would the Federal Reserve want to keep interest rates higher for longer if we have some of this economic uncertainty that you're talking about? And the really simple answer is they want to kind of have it as a card in their back pocket if things get really bad. They don't want to start decreasing interest rates right now and then get into a situation where things do get worse from an economic perspective. But they've already dissolved that option to decrease rates. So I think interest rates are playing a big part of it. And I know Chris is going to get into this. And we're going to talk a little bit more about it. But valuations are something we've talked about for, like the last 2, 3, 4 years. Valuations have been all over the board, particularly the Magnificent Seven, some of the AI and tech stocks. One of the biggest question marks in my mind with tech, AI, is, can they make money? I think, some of the pullback that we saw in the tech and AI space had to do with, we were at all-time highs for valuations. Some of the data was coming out about their earnings or their projected earnings. And I think the next few months are going to be really telling for the market because we're getting to everyone's favorite time of year, which is earnings season. So, I know NVIDIA's earnings call is going to be towards the end of May. That's going to be a focal point for the market. But, once we get into late spring and throughout summer, we're going to start getting some of these earnings calls. And I think one of the biggest question marks for a lot of people this year is going to be, can the AI and tech stocks post strong earnings and show that AI can be monetized and people can actually make money, with AI. So again, I can't really point to any one factor for the market right now. I really kind of think if it's a mixture, of all those different variables. But yeah.
That's great. Thanks, Jim. I don't know. Jim alluded that, Chris, you might have some comments on valuation measures.
Yeah, indeed. It's certainly been an interesting time as it relates to valuation as we look at the S&P 500. Really haven't seen valuations like this since the dot-com bubble, 99 into 2000. And when you have markets that are a little bit turbulent and we see some uncertainty like we've seen, the question always arises, are we overvalued? And valuation isn't a clear indicator of what's going to happen next. It's what expectations are and how that's priced into the market. And it's and how that's built in. And so we'll see what happens. I mean, if we look at some of the traditional measures, we are certainly overvalued from a market perspective. As we look at PE ratios being where they are, if we look at what's called the Shiller Index, which is a measure of inflation adjusted cyclically over time, we're certainly seeing higher levels there, which would be an indicator that we're going to see, lower returns over a longer period of time. And then we look at dividend yields, which are historically quite low, which means we're very dependent on what the appreciation is and what the growth looks like from a return standpoint. But for active managers, as we start to look at that space, really provides an opportunity for these active managers to extract out alpha. Active managers really struggle in a high valuation environment because they are very dependent in following the market. The returns have been so attractive with the Magnificent Seven companies. It's hard not to overweight in those areas because if you don't, the index is going to destroy your returns, relatively speaking, to your active management. But when we do start to see opportunities to move into value where they really focus on fundamentals and companies that have strong balance sheets, there is an opportunity there. So we'll see what happens as we continue to roll through. I mean, you had mentioned earnings. Q1 of 2026 is really the sixth consecutive double-digit earnings environment. So we are continuing to see strong earnings.
Mm-hmm.
We'll get into labor markets here in a few minutes and how that could impact that. But we'll see what happens. Long term, I think that we might be seeing periods of volatility and longer durations of not as attractive returns as we've seen the last 3 years.
Chris, thanks for those comments. Jim, you had mentioned a little bit about the Magnificent Seven, and I feel like we'd be remiss not to go deeper there.
Yeah.
What are your thoughts there?
Yeah. Again, I think the Magnificent Seven is something that we've talked about at length over the last couple of years, and for good reason. If you look at the last 5 years or so for the Magnificent Seven, in 2021 they were up about 40%. 2023 they were up 76. 24 they were up 48. And in 2025 they were up 23%. So they really have been driving a big portion of the market. They're also, one of the key contributors to higher valuations. Chris had mentioned that, we are seeing good earnings growth, which is true. But given the growth and appreciation we've seen in the Magnificent Seven, it's caused those valuations to inflate overall. And it's been a big contributor to some of the pullback we've seen. Year to date through 2026, things have shifted a little bit. We'll talk a little bit about value versus growth later on, but obviously the Magnificent Seven is very growth oriented. These are typically the securities that are very tech focused. There are Nvidias, are Apples, Microsofts, Meta or Facebooks, Googles of the world, and so when we're looking at the performance year to date through 2026, given the tech pullback, Mag 7's down around 11%. What's interesting is the rest of the market is only down about 1%. So again, we provided some updates on what's driving these pullbacks right now, but you'll see when we start comparing different sectors later on that though the broad market is down year to date, a lot of that is because of the concentration that we're seeing in the Mag 7 that we've talked about in the past. When we take out the Mag 7, things are a little more balanced, though we're still down 1%. But when we start looking at some of the more growth-oriented stocks in the market. Chris talked about active managers where we can find value. I think there's some good discussion to be had around that. In my mind, I think it would make sense to start talking a little bit about some of the different sectors of the market, particularly differentiating value and growth right now. Talking about some of the individual sectors and where we're seeing performance driven. Some of the weightings of those sectors, I think, paints a picture into where the market stands. And probably the bigger question is, where could the market go for the rest of the year? And so I think unpacking some of that data is helpful to understand that. Okay. I'm going to jump ahead and I'm going to talk about some of the returns and valuations by style on page 7. I know Chris is going to have some feedback here too, so I'll let Chris jump in as well. But, it's no secret the last 10 years growth has really dominated value. Some of those valuation metrics you talked about, kind of at an all-time low from a dividend yield perspective for the S&P 500. And a lot of that is just because we saw so much appreciation in the growth sector and a bit of a shift away from value. Growth-oriented stocks generally aren't focused on paying dividends. They're focused on reinvesting in the company. However, if you look at the performance over the last 3 months of 2026, things are shifting pretty notably. Growth is down about 10% year to date. Value's up about 2.1%. This is not to be unexpected when we see some of the economic uncertainty that we talked a little bit about earlier, when there's geopolitical concerns, when interest rates are staying higher, when there's valuation concerns, people tend to start shifting their focus and desire into holding things that are a little more predictable, like value. Value stocks generally pay a steady dividend. That's very predictable and easy to understand for investors. They usually have much more attractive balance sheets. So if interest rates are going to be staying higher for longer, a value-oriented company with a solid balance sheet is going to look a lot more attractive than a growth-oriented company. And so whenever we start to see uncertainty in the market, people begin to shift their focus to value, and we're beginning to see that right now. If I were to kind of give my 2 cents, this is always a risk because we never have a crystal ball. But for the rest of 2026, a lot can happen. But and depending on how quickly some of these factors that we've discussed shift, I see value making a push for the remainder of the year. There's just a lot of variables working in its favor. The geopolitical concerns, the interest rate concerns, potential jobs. These all point to value, providing investors with, a sound option for the remainder of the year. So, and as someone who is a deep value investor themselves, you never want to see the market flutter because it obviously makes our jobs easier. But I always have a soft spot for value deep down. So
You've always been a sucker for good yield.
I love yield.
Yeah, there's no question. I mean, we've certainly seen a meaningful rotation from growth to value, which is, we haven't seen that in some time. I mean, the growth has dominated the market as we saw all of this investment into technology. It's been interesting when you do look at large cap growth and where we're at with valuations that, investors really aren't being compensated for risk when you start to look at those numbers. And I think that value will persist throughout the rest of the year. And I think that, mid-cap value or small cap value, small cap blend, I think would be attractive areas to look at as we see that shift over. So it'll be interesting to see how things play out. From a market perspective overall, when you're looking at even the markets over the past, 30 years or so, we would see intra-year declines. So as we look at periods of volatility and we as we go through the first quarter and the date of this recording, I think the S&P 500 is down about 0.5%, and which is not unusual. I mean, it's normal for markets to kind of ebb and flow and move positive and negative. It's very healthy for markets as new information is introduced and that gets processed from the distribution of capital standpoint. But if we look over the past 35 years or so, with an average intra-year drop of about 14%, the market's still going to end up positive in most years.
Mhm.
And I think case in point, if you look over the last 3 years where we've really seen robust market returns, we were up 24% in 2023, we were up 23% in 2024, and we rounded the year of 2025 up 18%. Each of those years was down rather significantly at some point during the year. So, if we look at 2025 with the introduction of tariffs early on in the year, we were down 19% at one point, and we still came back and we're up
Mhm.
18%. So I guess as we look at it from a retirement plan participant or a plan sponsor and how that might play out, the importance of having a true investment discipline, to not try and time the market, to not extract your positions if the market falls. There is that emotional component to investing where the way things are today is the way they're always going to be, when we certainly know that that's not the case. So still looking for a positive year this year. We'll see how geopolitical events and the war in the
Mhm.
Middle East plays out. But with the earnings picture, I'm hoping for a positive year for 2026.
Jim, did you have something to add, or are we moving on to our topic?
I do want to talk about returns by sector a little bit on page 8 here.
You're on page 8. Okay.
Yeah. And I think this is important to talk about because when people look at the market right now and they see the S&P 500, year to date, we're down about 1%. But people see these big swings right now in the S&P. But if you drill into, what the S&P is made up of and where we're seeing some of these pullbacks, I think it tells a bit of a different story. So, for example, right now, tech makes up 33% of the S&P 500. Almost one third of the entire index is comprised of one sector. And so, when tech's down 9.1% year to date, it's holding such a heavy weight on the market that, it's going to, give a black eye to the overall market, even if other sectors aren't necessarily performing as poorly. And so, if we kind of go across the board and we look at, what are the top 5 weights in the S&P 500 right now, we have tech at 33%. We have financials at almost 13, consumer discretionary at about 10, and then, we have healthcare at 9.5 and industrials at 9. The bigger weights here, we talked about tech, but, consumer discretionary, financials are our big ones. Both of these are down about 9% year to date. And so, putting all those together, almost half of the index is comprised in 3 sectors that are down, 10% combined year to date. Some of the other sectors that, again, are a little more value oriented here, consumer staples up 7.7% year to date. Something like utilities, and obviously energy is the really obvious one, up 38.2, given some of the activity right now in the Middle East. They're making up much smaller portions of the market. Energy's at 4, consumer staples are at 5.3. And I think a lot of this has just kind of happened organically over time because we saw such a shift in the market to the Mag 7 and some of these more growth oriented names like the tech and the consumer discretionary spaces. But again, kind of going back to some of the points that we were talking about earlier around active management and diversification. If you're someone who is just an index investor, you're likely going to be subject to some of these overweightings in the different sectors. But if you're someone who has good diversification, or you're using good active management, or you're engaged with an advisor, having exposure to all these different sectors, is really important. Can try to help dampen some of the concern that we're seeing in the market right now. But I just think it's interesting to look at because the 3 largest sectors are what's down right now. And I think that's painting a bit of a darker picture than we're actually seeing in some of the other sectors in the market. So this is a question. This isn't meant to be a joke, but in your guys' time, have you ever seen one specific sector hold 33% of the index?
We wouldn't have been weighted that much when we do go back to dot-com bubble era. I don't think we would have seen that high of a weighting. Even as we went through the financial crisis, I'm not sure that we had that much exposure to one particular sector.
Yeah, it is a unique time from that perspective.
Mm.
Yeah.
It's hard to ignore the returns, though. And that's really the issue that the active managers fall into is they have to almost index and hold those weightings, or they're just not going to keep pace.
Mm-hmm.
Well, it's interesting from a behavioral finance perspective because, we've got we know plenty of individuals that hold individual positions in some of these tech names.
Yeah.
And when they pull back a little bit, it right sizes their ego, if you will, right? To say like, wait a minute, diversification does make sense,
Right.
particularly when you go 15 years and growth has been outweighing value.
Mm-hmm.
And now we're seeing a little bit of a reversal.
Yeah.
It does help.
Yes.
Yeah. Right size expectations from a diversification perspective.
I think it's probably important to talk about the job market.
Yeah.
And look at labor markets. It's a critical factor with what the Fed's looking at. We'll get into that here in a moment. We've really seen a weakening labor market. If you look at the trend line since 2021, the labor market continues to weaken. We've really gone into this no hire, no fire environment for a lot of major companies. We're just not seeing really any kind of growth there. We look at non-farm payrolls, and the data that we produced by the time we went to print with our analysis for this quarter. February was down significantly, 92,000 jobs. We did see a bounce back in March where we increased payrolls about 178,000. But that's really, I think, an anomaly. I think we're going to continue to see a downward trend as it relates to the labor market. And in typical cycles, you're going to see payrolls decrease, and then you'll see a lagging indicator of unemployment start to increase. And that will, of course, follow with wages falling. And I think we're starting to enter that period of that cycle where we'll see that inverse relationship of unemployment and wages. And I think that's going to continue when you start to look at where AI technology is taking and how that's going to impact the workforce, and as that gets incorporated into the DNA of our businesses. As it relates to the Fed, a decrease in wages will provide some relief in terms of inflationary pressure.
Mm-hmm.
But if unemployment starts to tick up, and it's been 5.5% is, if you look at the 30-year average, we've been below that for some time. But if that does start to increase significantly with their dual mandate of full employment and low inflation, we will see more accelerated rate increases. So it'll be interesting to see how the labor markets look here for the rest of 26.
One thing I want to hit on briefly that we talked about last quarter and I thought was pretty significant was just the U.S. dollar. And I think that relates pretty significantly into some of the international markets. Last quarter we talked about, international markets were performing really well. And particularly they're performing well because they were getting a premium on the currency exchange rate. We're thinking about mutual funds in our world, converting that back to USD. Given the dollar was weak, we were seeing a lot of appreciation for some of the international funds that we use for clients in 2025 and in the early part of 26. But the U.S. dollar has strengthened a little bit throughout Q1. Still not quite the level that we would expect to see it. But just to talk briefly about what's driving that. Last quarter I mentioned some of the contractors for the U.S. dollar were the question marks around interest rates in the U.S., but more particularly the slowing trade. There were less countries who were trading with the U.S. because of tariffs that were presented in Q1. That created an environment where less individuals are buying U.S. goods and services, and so therefore they were using less U.S. dollars to do that, and so we saw our dollar weaken. Fast forward to 2026. While there still is some uncertainty around tariffs, we're seeing trade start to normalize. So U.S. dollars slowly gaining ground. Another important factor that was that's changed in 2026 is last year we saw interest rates falling in 2025, and when we see interest rates falling, that tends to weaken currency. In 2026, given what we discussed earlier, expectations have shifted, and there's an expectation now that rates are going to stay higher for much longer. So that's also helping give the dollar some strength. And then I would say the last factor is when we think about whenever there is uncertainty, whether it's geopolitical uncertainty, whether it's market uncertainty, people use the U.S. dollar as a safe haven. And so, given what's transpiring on a global scale right now, given some of the economic uncertainty Chris just talked about with jobs, people tend to fall back on the U.S. dollar as a safe haven. So, again, we're not making huge strides by any means, but we did see some slight strengthening of the U.S. dollar throughout Q1, and that could be a great thing for the remainder of the year. Doesn't shift a lot of expectations internationally. I still think in international markets have a sound place in all portfolios. I think there's some value to be had there. We'll maybe talk about valuations a little later on in the international markets, but I think the U.S. dollar has just been something that I've personally been focused on a lot over the last year or so.
Yeah, I think you're on point, Jim, with your points. And, it's really hard. The capital markets in the U.S. are just such a strong magnet for just continued investment here. It's interesting to see. I think we would see significantly lower, exchange rates if we didn't see, have that just capital engine here in the U.S.
Mm-hmm. Sure.
Chris, it's a great point. We could probably move on to another topic here. What else do you think is important here?
I think if we look at oil markets, I think it's important to consider that anytime we have any conflict in the Middle East, that's of course going to be a big part of the conversation, and we're seeing that now. But as if you go back the last couple of years, going back to 2023, it's been interesting to see because oil markets are always about supply shocks, demand shocks, and where we're at in terms of productions, and where we're at in terms of consumption. U.S. markets, we continue, if we look over that period, we've increased oil production about 20%, really due to our shale flexibility and our ability to produce oil. OPEC kind of operates in that quota environment, and we haven't seen any substantial gains there in terms of production. And Russia, which of course has a huge capacity to extract oil, really haven't been able to do it because of really geopolitical events and the constraints that are put on their economy around the world. From a consumption standpoint, the U.S. continues to be pretty normalized in terms of their actual consumption, and we've seen China and India increase production consumption significantly. But as we look at inventories, we saw a significant drawdown in oil inventories going back to 22. We really don't have a lot of room if there is a significant shock, and we're going to see price increases very quickly if there is a substantial shock to the oil supply. So we'll see how that plays out. Of course, the price of oil certainly runs in cycles. It's not a straight line, but really, again, driven by oil shocks and how that impacts that supply-demand factor.
So pivoting to international markets, Jim, what are your thoughts there?
International markets, 2025 was a great year for international markets. Talked about that quite a bit. If I look at some of the benchmarks here, Europe, in particular the Eurozone in 2025, was up 41.3% when taking into account the currency exchange we talked about. Fast forward to 2026, just like the U.S. markets, we saw some volatility to start the year. I still have some optimism in the international markets. There's a lot of investment going into some of the different international sectors. I think one of the biggest pieces that has shifted slightly, but I wouldn't say notably, is when we start talking about valuations. Chris, you highlighted that U.S. valuations have come back a little bit to start out the year, but we still remain really high. Your current PE ratios are at almost 20 times versus our 20-year average, which is at around 16 and a half, 17 times for the U.S. markets. Some of the other international indices like Japan, Europe, China, the emerging markets, much closer to their 20-year averages. We did see a slight uptick throughout 2025, just given the strong performance that a lot of the international markets have. But even despite that strong 2025, from a pure valuation perspective, it would tell us that international markets have a much deeper value play than the U.S. markets currently. So I still remain optimistic on the international front. One thing that I think is, Mike, you talked a little about earlier, if you use the word humbling, a lot of times when we're talking to like plan sponsors or investors, about building target date models or building a diversified portfolio, no one likes international exposure. Everyone loves the U.S. markets, and it's because the U.S. markets have performed so well for the last 10 to 15 years. And I think last year, particularly when we started out in 2025, we saw the market pull back, but international markets were just performing really well. It was kind of a stark reminder for everyone on to why it's important to have diversification internationally. Uncorrelated exposure is important. So again, we never want to say like I told you so, but sometimes it makes our job easier when we're trying to get recommendations across to people.
Well, unfortunately, we've been telling that story for a long time, and sometimes the diversification story has not played out. It's an unprecedented period of time that large cap, even growth stocks have dominated. So seeing a little bit of a reversal does bring back the story around diversification.
Yeah, when it is hard to have that conversation on diversification, especially when we've seen years of stagnant returns in international markets, and it's hard to convince individuals to allocate in that direction. We've certainly seen very strong returns internationally last year. I still think it's more cyclical than structural. I still think the U.S. will ultimately be, the highest returns, but I think that you are going to capture those cycles as international markets move up and down. And I think it's critical to have exposure to those areas as we continue to advise.
Excellent. Thanks, guys. Any closing thoughts about? We didn't talk about gold. I know gold is kind of a big deal, and
I actually do want to talk a little bit about gold.
A lot of folks have, really, it's a lot of times gold is the boring thing we don't talk about, but that's not the case right now.
No, I have a couple clients who talk to me quite a bit about gold. So if you guys are watching, we'll be pretty excited to hear this. But when we talk about gold, particularly when there is concerns around the U.S. dollar, inflation, really any potential geopolitical or economic risk, gold shines. I don't know what the exact number is, but during a plan review last year, there was one client that has a particular gold fund, and it was up over 100% during a 1-year period, and that can give people some wide eyes. But looking at some of the data we have on 24, in high risk environments like we've sat in for the last year and a half or so, gold's going to look really good. We talked about we have a weak U.S. dollar. I pounded the table like
pounded the table.
I pounded the table.
Sorry, it's contagious.
Sorry.
I missed the pun he made. Did you catch the pun he made?
No.
About gold shining?
Oh, no, I got it. Yeah.
I totally missed. I missed catching it.
Come on,
So,
guys.
yeah.
I got dad jokes now. I was saying, if we look at page 24, obviously during high risk environments like we've been operating in the last year and a half, U.S. dollar's been weak. There's been inflation concerns since 2022. Gold looks really good, but when those concerns aren't there, generally gold is not necessarily strong investment data would say. On average, around 6.7%, which frankly hasn't been too far off and some of the market returns on average were around 8%. So the one thing I will say is I don't want to discount or dismiss people who want to invest in gold because I think it does have a place in a portfolio, but I don't think it should be the only place in a portfolio. Sometimes I hear people say, hey, I'm going to move everything I have to gold because of what's happening right now. And especially in today's day and age, it's really difficult to time the market and things can change on a dime. So if you have all your money in gold and all of a sudden the market shift, a different direction, it really puts you in a pretty poor position. So I think it can be a small, sleeve in a diverse portfolio. But I think sometimes people dismiss it, or sometimes people go all in. I just think it's important to think about your portfolio as a whole. So, but definitely worth talking about.
Couldn't agree more.
Good stuff. All right, guys. Thanks. That's a great talk on Q2 capital markets. Thanks for joining.
Thank you.
Thanks, Mike. Thanks, Chris.